Welcome to the Daily Brief, where I'll go over the highlights for the action in the market for Tuesday, January 3rd, and then we'll see how things look for Wednesday, January 4th. We had another down day. We were a bit lower, but we ended up closing off of the low, but it's still keeping our technical picture pretty negative. We have a few areas that are extreme negative right now, so we want to be aware of those, especially in the short term. And we saw a pretty positive upward movement right into the open session. And we gapped higher right at that point. And then we lost that pretty quickly, shot back down, and then ended up going negative. Please be reminded that this coming Saturday on January 7th, there is a free webinar that's available to you. It's called the Market Vision 2023. My understanding is this will be a way to look into 2023 and see what should we be looking for? What does the outlook look like? And I don't have any connection with this. I'll just be a fellow attendee with any of you who decide to go, but it's free. And you only have to supply your email address and your name. It does start at about 9 a.m. Eastern time, so you may have to adjust that, but depending on your time zone. But we'll just have to see. Sometimes I go to these webinars and I find some useful information. Other times it was pretty much a waste of time, but that's how you learn, to take the good from the bad. So I try to attend as many things as I can just to see if they're helpful. Because if you learn one little tidbit of information, or maybe you're looking at something in one way and that causes you to shift a little bit in how you look at things, sometimes that can be very powerful for us. So let's go back and talk about what happened. Right at the open, we had a gap higher open, and the futures, they had been up over 1% during the night. They fell back and were down anywhere from were up anywhere from 1/3% to about 0.5%. That helped give a higher open, and it's not necessarily surprising. The first trading day, I remember a few years back, I had what's called a straddle. That's where you have a call and a put at the same strike price, because you think the market is going to move, but you don't really know in what direction. So you play both sides, realizing that one side is going to lose with the hope that you will profit on the other side, and it will make up for the cost of getting into that position. Well, we had a higher gap open, and that hit my profit target for the call. So I got out of that. Well, at that point, the put had lost a lot of value, so I just hung on to it, and prices reversed, went down, 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 eventually to the point where the put became profitable as well. So I was able to benefit from both sides on that trade. Can't plan on that happening a lot of times, but especially on the first trading day of the year, I've seen that happen a few times. And it happened again on Tuesday. Right with that open, we got up to R1 at 38.53. We went above that up to R2 at 38.66, and that didn't last very long. We quickly started retreating. We went all the way down to the unchanged level and then down to the pivot level at 38.27. As the day went on, we tried a little bit of a bounce after that kind of quick decline. Prices then fell below S1 at 38.13. So the bounce quickly fizzled out. And then we went down and we were starting to bounce around that 3,800 level. And yeah, we did go below that, but when everything was said and done, we were able to come back up off of that, get back above 3,800, and that turned out to be a good sign of support. So even though 3,800 is more of a psychological support level, it's becoming more of a technical level, because we keep going right down to this, and then so far that has held up. If we look to break below 3,800 and then close below that, that's going to turn things in the short term anyway a lot more negative. And there's probably a whole lot of stop loss orders and a whole lot of people that are getting ready to profit from the downside if we really break below 3,800. So we just want to keep an eye on that, have that tucked in the back of our mind, And if prices continue to come back down to 3,800, really watch and see what happens. But in Tuesday's session, we were able to rebound up off of that 3,800 level, and we rebounded almost up to the daily pivot. Going into the close, we were down 0.4%, and volume picked back up a little bit. It still may be a little bit lighter than usual. A lot of folks may be taking this week off now and then come back next week, but we are seeing a lot more participation as far as volume is concerned. The technicals are still negative overall. We're getting a few readings with our short-term indicators that we're getting extreme negative. Doesn't mean we have to stop, but we just want to be aware of that. In the intermediate term, we're not seeing anything that is extreme negative currently. And a lot of this is being blamed on the inflation and interest rates. That's the fixation of the markets right now. Here's the intraday chart showing, and it was kind of interesting, during the night, the S&P futures were actually up over 1%. We came back down, we dropped below 0.5%, and then being up 1/3%. And then as we got closer to the close, they started to go back up again, and that helped really produce this opening gap higher above R1, actually a little bit above R2. We went all the way up to about the 38.78 level, and then all of a sudden selling kind of quickly came in. We came down below the unchanged level, down below the daily pivot. We did try a little bit of a rebound, but that didn't work. So we went down below the daily pivot, down below S1, and then here we are flirting around with the 3,800 level. We actually tested that a couple of times before seeing a rebound, coming back up into the close and almost getting back to the daily pivot. Please be reminded that every day that I post a video, I update two charts, a intraday chart that gives you the pivot points for the next day, and then a monthly chart, which the pivot levels don't update, but every day's price does. So I just include those for your reference. What are some comments that we can make? We have 1 day left in the supposed Santa Claus rally period. It usually carries over into the first 2 trading days of the year. Well, Wednesday's session will be the second trading day. So if we're going to get any positive seasonality, at least on this textbook definition of a Santa Claus rally, it's probably going to happen in Wednesday's session. Then please be reminded also, this could help a lot of U.S. companies where China is lessening their quarantine requirements, and that'll be starting on January 8th. That's actually a Sunday, and that will feed over then into Monday. This could help companies that do business in Japan. It could also help companies that are depending on the supply chain of things coming from Japan. And then, as I said earlier, support at 3,800, it continues to hold. Even though we dropped a little bit below that, for right now, it's holding. We're really going to watch it if prices start to fall down below that. In Tuesday's session, the 20-period exponential moving average acted as resistance, and I'll show you that with our moving averages. The VIX is still acting strange. We're starting to really spike up now, and I updated that chart a little bit. Some of the lines were getting a little off kilter. And this has to go with a lot of the earnings per share and the valuation concerns. If earnings are coming down, and I have another Yardeni chart to show you of that will feed over into stock prices and could really at least promote the idea that stocks should go lower because they are considered to be overvalued. The US dollar did decline in Tuesday's session, and interest rates were mixed. We had really the 10-year was flat, but some were up and some were down. On a short-term basis, the two charts that I've been showing in these videos, the PMO studies and the stochastics, they're still giving us some extreme negative readings. And then the Williams, that should be %R instead of $R. That's another really short-term indicator that we use. It's starting to go extreme negative. But the other one, the Stoch RSI, which is also short-term, that hasn't gone extreme negative yet. The yield curves that we've been watching, and I don't know why this is changing here, the 40 to the 5, I don't think we have a 40-year bond. But I was going through and changing the date numbers, and some of the yield curve numbers got changed too. but we still have a number of curves that are inverted. Sentiment is still fearful. We have not dropped yet into that extreme fear territory, at least yet. And we had construction spending that came out. It was up 0.2% on a month-over-month basis. That was higher than the decline that they had anticipated of being down 0.4%. The last time we had this report, it was down 0.2%. Total private construction was up 0.3% on a month-over-month basis. And total construction spending, public spending, was down 0.1%. On a year-over-year basis, we're still growing at a pretty hefty rate of 8.5%. The final IHS Market Manufacturing PMI reading came out. It was unchanged. The last time we had this, it was at 46.2, and we had that same reading this time. Our trend is negative, and it's just barely above the moving average. They're almost on top of each other, but we're still below 20, so it's suggesting this trendless market that we've been seeing. Our bias is negative because we've now had 2 down days in a row, and I've switched our momentum back over to negative. We need a lot more follow-through buying to have our momentum switch back to positive. This is a chart that I showed in the previous video that kind of deals with the scenario that companies are starting to have to lower their earnings per share estimates going forward, and we're starting to see that in their earnings reports when they come out. We're really paying attention to this white line, and it was doing okay, and then about springtime of 2022, that's when it really started to go down, and it's starting to cause some concerns to the market that the white line is the earnings per share. This kind of orangey line, this is the estimated profit margin. Those are also declining. And then the sales, they're kind of flat, but overall they've been starting to taper down for the most part. And this is what you don't want to see in a positive stock environment. Another chart that I got from IsabelNet, this is just looking at the estimate if we're in a recession versus whether we don't enter a recession. So if we don't have a recession, and if the PE ratio for the stocks in the S&P are at about 17 times earnings, that would give us $205 per share, and that would be this top area up here where we could expect to go up, and that gives us a reading of about 4,500 in the S&P 500. If we have this soft landing, which seems to be this elusive thing, then we will have earnings per share of about $205 as well, but that could really start to take prices down to a little bit over the 3,000 level, possibly about 3,100 or so. And then if we get into a deep recession, which a lot of people are very fearful of that, prices may get down to a 15 times earnings, with earnings also falling, and that could take us down to about the 2,400 level from where we're at right now, roughly about half of what the S&P is at now. So that's why we're watching this pretty closely, because this could really, especially if this last scenario where we get into a very difficult recession and nobody knows what's going to happen. People can have their opinions, but that doesn't really matter. We have to follow what are the economic reports telling us, what are the forecasts looking like, are they being adjusted, and then look at the charts to say, are we going lower, or are we going sideways, or are we going higher from here? This is just showing our model of going forward that could still suggest, based on the price going from 2006 through 2008, that we still could see more weakness going here, because we seem to be following the same basic price pattern that already happened before. The white line here is the S&P 500. The VIX, though, we're not really following this. We spiked up a little bit. We're still into the low to mid 20s right now with the VIX. But if we were really going down, we would want to see this spike up, but that's just not happening. Here's the VIX to the S&P 500 ratio. This continues to spike. So we're watching this go up and up and up and up. And these are the lines that I adjusted on here. They were getting a little out of whack as new dates were being drawn onto the chart. So when we get a high reading and then start to come down, These red lines are when that's happened in the past. And then you can look down below to see that most of the time, the S&P had a short to intermediate term downturn when this finally topped out and started coming down. So we just want to be aware of that. The ulcer index is just showing that fear continues to advance overall. And with down days, that's not necessarily surprising. Here's our equity put call ratio, a 1-day chart where we just had this monster spike up. And now we've been coming back down since then, getting more to a normal reading. But when we look at the 5 period of this, now we're seeing, can we work off of this spike as this is coming down? The problem with this, and I've been trying to point this out, is we're not seeing any kind of capitulation in price action. Other times when we had a spike, that marked a low, and it was usually a scary low where the media is talking about it. Everybody's saying, I don't want anything to do with stocks anymore, and the market's never going to go up again, ever, as long as I live. That's when we look for capitulation. Well, we've been just chopping sideways here, so we're not really showing any kind of capitulation at this point. So we want to be suspicious of this, but we want to keep an eye on it at the same time. And then here's the longer term look at that same chart where we just had this monster spike, but it didn't really correspond. It corresponded to the sideways action that we've been seeing. Our trend, you see it went down a little bit, but the ADX is just slightly above the moving average. So we still say that it's strengthening, but if we have another down day, this is probably going to roll back under the moving average. And the red line's on top, even though it's declining, so we're still defaulting to the negative trend. Haven't shown this in a while. I bring this up, our double and triple exponential moving averages. We came right back up to this moving average going back to the COVID low, and that is providing overhead resistance. The one oscillator that is turning negative is our slope. This tends to be a little more touchy. All of our other oscillators, a few of them are showing some improvement, but they haven't crossed over positive yet. However, the slope has crossed positive. BPI ticked up just a little bit, and it seems to be holding up, but it's also picking up that we've been in a range for the last number of trading days. So we want to see how this is going to act. It's a little bit more to the negative side because it's below 50. When it's above 50, that's considered positive. Below 50 is negative. PMO studies, those PMOs that are rising, after giving us an extreme negative reading, they came back out from that, but we're still not really looking very healthy. The one that's giving us an extreme negative reading are the buy signals, and then those PMOs that are above zero continue to decline. Stochastic starting to get extreme negative in the short term, trying to turn up a little bit in the intermediate short term, and rolling back over and not showing a lot of improvement in the long short term, because all of these together measure the short term. Daily chart, we're kind of just right on this pivot level right now. And you can see how we've just been dancing along this. And the market's waiting for some kind of a catalyst to either push us up or take us down. Our moving average tree, here's the 20-period exponential moving average. That was just about at the high, and then we started coming down from that. If we do end up going higher, these moving averages may end up providing resistance. Summation index, declining still based on price, but we're seeing a little bit of a turn up based on volume. The top indicator and the bottom indicator, they calculate differently. So that's why we can get different readings from these. New highs, new lows, not really breaking out with new highs or new lows. So even though this is turning up a little bit, we're still negative with the 5 period and flat right now with the 10 period. The Elder Impulse is still giving us a neutral reading since it's blue. Ichimoku Cloud still holding up with support here. Our fib level still holding up with support with this double fib retracement level. Longer term, we're right on the fib level. You see how the market's kind of working its way into a tipping point, either positive or negative. but we're still above this 200-week moving average. And we're just a little bit underneath the midpoint of the trend channel. If we can break above that, that would turn things more positive. If things do switch more negative, we will drop down below the midpoint. The mid caps, I showed this in yesterday's video where we're seeing a golden cross, but price still is below both of the moving averages. It needs to get above these moving averages for that to turn more positive. And then our Dow it's a little bit below the 50-period moving average, but we had a recent golden cross, but we've been chopping sideways. So what's our outlook then? The technicals are negative, but we want to know, we have 1 day of the Santa Claus rally left, the official definition of that. Can something positive happen with that? We have the MBA Mortgage Applications Index, the ISM Manufacturing, that's a biggie that will be coming out. The JOLTS job openings, and then the FOMC meeting minutes from the December 13th and 14th meeting. They will be coming out at about 2 p.m. Eastern time. The whole list of geopolitical events, with inflation and interest rates really being the big concern right now. And you're starting to hear more of this debate. Are we in a recession? Are we not? Are we going to be in one? Is it going to be stagflation? Is it eventually going to lead over to deflation? And like I said, everybody has an opinion that talks about these things, but we need to look at what the information is telling us and then go from that. So our scenarios can't really go with the down one because we're not trending. Even though our technicals are negative, we are still in that range. Can't go with the positive one because everything's pointed downward. Our technicals are just not positive now. But if we do start to go up, we might hit some more moving average resistance. The pivots and the fib retracements, those are still holding up. So they're providing some support. But if we start to go higher, we're going to bump into resistance. So we're still going with the sideways scenario because the ADX is strengthening a little bit. It's just barely on top of that moving average, but it's still below 20 and the red line's on top, so it is negative. Our conclusion, the S&P is negative and still in a range. Short term, just a little bit oversold, but it's negative. Intermediate term is still just flat out negative. Long term is negative because we're below the 200-day simple moving average. Thank you. Have a wonderful day on Wednesday, and Happy New Year again to everybody. And I will look to prepare the next video after the market closes.